So to our first speaker, Phillip Glyde is the big kahuna at ABARES. He's the man with the shortest bio here, so one would assume he's got to run the place. His work has been with the government in natural resource management, environment, and industry, both in the domestic and international spheres, but also the OECD overseas, back here with the Environmental Department, and the last 6 years in agriculture. Most importantly, he's overseen the big merger with science. And the topic he's talking to is one that every man in the street wants to know about today: the outlook for Australia's commodity sector. Phillip.
Thanks very much for that introduction, Tiki. Very grateful for that, and I'd like to acknowledge the traditional owners of the land on which we're holding this 41st Outlook Conference. I'd like to welcome you all attendees, particularly those of you who've travelled from overseas, but also in particular those of you who've travelled from the flood-affected parts of Australia. Thank you for being here. I'd also particularly like to acknowledge and welcome some visitors we have from New Zealand. We thought we might not have as many as we usually have because of the tragic events in Christchurch, but we've got representatives from the Ministry of Agriculture and Forestry, the Ministry of Environment, the New Zealand Reserve Bank, the High Commission, and Mandy McLeod, a Nuffield scholar from New Zealand, is here to talk later at Outlook. So thank you and for coming, and welcome to everybody. It is great to be here. As Tiki mentioned, this is our first conference as an integrated bureau where we're combining the science, the economics and the social science. We believe that will provide a much stronger underpinning for better quality policy analysis and hopefully better quality decision making, both within government but also within industry. Floods and cyclones have pretty much dominated the media over the last 3 months, certainly dominated the rural press. What I wanted to do today was to contemplate the devastating consequences of those floods at a personal and farm level and a community level, but to try and look through those, to have a look at what does that mean for our short-term forecast, but also what do extreme weather events like Cyclone Yasi and the significant flooding that we've experienced over the last little while, what do they mean for the long-run future of Australian agriculture? But first of all, our assumptions. As Tiki said, when you're looking into the crystal ball, it's pretty important to know where you start. 2009, as we all know, saw a significant contraction in world economic growth, a reduction of about 0.7%. That was followed by a rebound to around about 4.8%, reflecting the coordinated monetary and fiscal policy responses of governments around the world. In preparing our forecasts for commodities that will be presented in detail over the next few days, we're assuming global economic growth will average around 4% next year, 2011 and 12, and out to the end of our forecast period out to 2016. This chart shows the components of that global growth as we are assuming. You can see this year's estimates in blue, next year's in green, and the following 5 years in that sort of orangey browny colour. What we're expecting is there to be relatively weak growth in the OECD countries. We're expecting strong economic growth in China. Whilst we're also expecting it to moderate, we're still assuming it's going to average around 8.5%. And there's also, we believe, going to continue to be strong economic growth in emerging Asia. Under that sort of global environment, Australian economic growth is expected to be relatively strong over the medium term. The flooding in the eastern states we're expecting will reduce economic growth by around about 0.5 percentage point, and we're thinking that it will be around about 2.1% for 2010-11. We're also expecting that growth will rebound to about 3.9% in 2011-12 as the rebuilding gathers momentum following the flooding and cyclone events. We're expecting that it's going to average 3% in the medium term. Just in terms of our assumptions about inflation, we're expecting inflation to reach 3.1% in 2010-11 before easing to around about 2.5% by 2015-16. Critical assumption and an issue that's been of much debate in the rural press and media is the exchange rate. We're expecting the Australian dollar to remain at relatively high levels over the next few years before declining in the medium term. The axis on the left-hand side shows that we're expecting it to decline to about 90 cents in the dollar by 2015-16. As you can see from the red line there, the lower line, which is the terms of trade, which is simply the ratio of prices we receive to the prices we pay, that's what has been underpinning the significant increase in the value of the Australian dollar. We're not expecting that to change too much. Continued strong demand for mineral resources, particularly from Asia, is expected to keep the Australian dollar relatively high over the outlook period. We're also expecting farm commodity prices to remain relatively high in the short term over the course of the next year, and however we do expect them to moderate over the medium term. The price outlook for the individual commodities is what is really critical, and that will be discussed in greater detail over the next 2 days in all the individual commodity sessions, and I commend them to you. You'll also note from that upper line there that we're expecting mineral prices to remain very strong, certainly to continue to rise over the next couple of years before easing it towards the end of the outlook period. Mentioned before about the impact of the recent weather events. Clearly the flooding events and the cyclone events we've seen have been devastating for a lot of communities, for a lot of farm businesses and for a lot of individual families and communities. It's also had some fairly significant effects on agricultural production. I talked earlier about the weather events knocking about 0.5 percentage point off our GDP, but the heavy rainfall led in November to mid-December, by our estimate, led to some significant downgrades in the quality of winter crops, particularly wheat, and sugar was also particularly badly affected. Our best estimate is that would reduce agricultural exports by about almost $1 billion. The flooding that occurred in late December to January knocked a further $1 billion off agricultural production by our best estimate, and also reduced coal exports during that period, and will continue on because of the closure of mines, but also the closure of the infrastructure and the like. And finally, Tropical Cyclone Yasi, we believe will have an impact of about a reduction of about $300 million in growth in production in North Queensland. So, however, despite these events, we're expecting the value of farm exports to rise in the current year we're in 2010-11 to about $31 billion, and rise a further 4% in 2011-12 to $32.5 billion. So while the flood and cyclone impacts were devastating, they weren't sufficiently large to knock down the recovery of the sector from 10 years of drought. The recovery is not complete, of course. There are parts of Australia, particularly Western Australia, that are experiencing drought, but it's, in essence, the floods and the cyclones have knocked the gloss off what would have been a very good year. Turning to a slightly different scale for the charts, this shows our projections, our forecasts for the value of Australia's mineral resource exports. You can see that we're expecting them to still be around about $186 billion in 2010-11, before rising by a further 16% to $215 billion in 2011-12. So more records will continue to be broken in the minerals and energy export sector. If we put it all together and have a look at the total value of Australia's commodity exports, where you've got the mineral resource exports, forestry and fisheries exports and farm exports, you'll see that we are forecasting for 2011 and 12 that we will be within very close to at least $250 billion in terms of export performance, which is a new record in Australian commodity exports. At the start I said I wanted to talk a little bit about the longer term and what the prospects are beyond just the short term. I guess in the next year or two, the prospects for the farm sector look bright. It's always a bit hard to say that given the difficulties that people have experienced during the course of the year. But this chart shows irrigation storages across the Murray-Darling Basin. All I'm really trying to show here is that They're currently sort of north of 80%, and this time last year they were around about 25%. We've seen a spectacular replenishment of our farm storages. In addition to that, soil moisture profiles have been replenished in parts of the country, and we're emerging from drought in other parts of the country as well. World prices, as I said earlier on, we're expecting to remain relatively high for the next 12 months or so. So whilst in-season weather events will, of course, still be the largest driver of production and export, there's still room, we think, for some optimism for the next year or two. In terms of the longer term, we know through almost any climate change scenario you'd care to think about, we know that we're going to be in for increased severity and increased frequency of extreme weather events. The events of the last 3 months have given us a bit of a glimpse of the future, and there's been much debate in the media about the best way for the farm sector to insure itself against future events like this, which, as I said, are meant to be more frequent and more severe. We've heard of talk of calls for multi-peril crop insurance. We've heard calls for governments to underwrite these sort of losses into the future. It's ABARES' strong view that the best insurance policy that governments and industry can take out for this uncertainty, for this climate uncertainty, for these increased severity of events is investment in productivity growth. Those of you who've been to an outlook over the past 5 years will know this is probably my favourite slide. It shows how the sector's stellar performance in terms of productivity growth over the last 55 years has underpinned the competitiveness of the Australian farm sector. It's allowed Australian farmers to remain competitive while our terms of trade, which are the prices we receive for our goods compared to the prices we pay for the inputs to those goods, they've declined significantly over that same time period. They've fallen by 2.2%. This is a great success story. We've outperformed the rest of the Australian economy by some margin. But in recent years, as most of you will remember, our performance has faltered just as we needed it to be increasing to face the challenges, the uncertainties that are coming before us. With the assistance of the Grains Research and Development Council, we've spent the last little while having a closer look at some of the drivers of productivity. Just wanted to share with you where we've got to and I guess provide a highlight for some of the work that we'll be showcasing in more detail in later sessions dealing with productivity. We believe there's 3 groups of factors that drive productivity growth: macroeconomic conditions such as the exchange rate, interest rate, the government policy settings in that regard, things that farmers find it a bit hard to control. A group of external factors, again, such as the terms of trade, which we've talked about earlier on, consumer preferences, how they might change, and the like, the quality of the farmland and the quality of the resources that people have to use in producing farm outputs. Again, these are things that are hard for farmers to influence. The third group of factors are where the farm manager can actually have some influence through decisions to innovate, decisions to change product mix, decisions to expand farm size, to improve the level of knowledge of the people operating the farm. All of those things are drivers, and we've been looking at what it is that creates that innovative operating environment. What are the things that will make our best farmers invest in productivity growth? And what is it that is stopping some of our farms investing in productivity growth? Clearly, macroeconomic conditions and external factors are a big influence, as I've said all along. But what we've been able to determine is, I guess our thinking has been that there's 2 things that contribute to that innovative operating environment. The first are what we've called enablers. They're the things that actually make lifting productivity possible. Things like research and development, investing in human capital, developing infrastructure. The second area, though, is the incentives. It's one thing for those things to exist, but how do we encourage farmers to take action, or how do we remove disincentives for taking that action? I'd like to explore both of those issues in a little bit more detail just to show you what our most recent research is revealing. Turning on to the enablers side, this chart shows what we've been able to determine from our farm financial survey information that we're very grateful for farmers for sitting down and providing that to us on an annual basis. What we've found in that over the last 55 years, we've looked at what are the sources, where is the productivity growth coming from?